Everybody, I think we'll get the proceeding started here. So if everybody could grab their lunch and be seated, we'll actually get proceeding here. Let me first of all thank all of you, this very distinguished audience, for braving today's cold. I think your efforts will be well rewarded here with our speaker today, Tom Hoenig, who's been the vice chairman of the FDIC since 2012. And before that, Tom had 38 years at the Federal Reserve, 20 of them as president of the Kansas City Federal Reserve Bank. I guess Tom didn't actually get the memo about the revolving door. You know, the revolving door is supposed to be you do your public service and then you go off and cash in big private sector rewards. Well, Tom's revolving door led him from public service at the Fed to public service at the FDIC, and the rest of us all feel very fortunate for that particular turn of events. On a personal note, I should say it's a very great privilege for me to host Tom here this afternoon. For over a decade, Tom and I sat 3 seats apart at the table for the FOMC meetings, and some of those years out of that decade were quite challenging, as a number of you here will certainly recognize. Tom didn't always agree with my forecast, and I didn't always agree with all of his policy positions. But in this time of very fractious public discourse, Tom really did, I think, provide a very positive example and distinguished himself in his participation at the FOMC. Because Tom, I think, demonstrated through his own actions, you can hold and advocate forcefully a position, even a controversial position, but you can do so with grace, humility, and healthy respect for the alternative points of view of your colleagues. And that seems to be a quality that's in pretty short supply these days when one looks at the public and policy discourse. I'm guessing that Tom Hoenig does not have a selfie stick, and I'd not even be entirely surprised if he didn't know what a selfie stick was. But he's a very, I think, thoughtful, humble, and important policymaker here in Washington. Tom, thank you for being here. We look forward to your remarks, and the floor is yours.
Well, first of all, I want to thank David for the very generous introduction. I was sorry to hear that he said he didn't always agree with me, because I always thought secretly he did, and now I find out maybe not. I also want to thank the Peterson Institute for hosting me here. Can't hear? How about, okay. I'm going to have to lean forward here a little bit. I want to thank the Peterson Institute for hosting me here today, because what I want to talk about is an issue that I think needs a discussion, increased dialogue, because it does have implications long-term for the global financial industry, not just the U.S., although I'll focus on the U.S. And it's you're going to hear the acronym TLAC quite a bit, which tells you why we have to do it at an institute. You can't use terms like that in lay world, since it's hard enough even within an institution. But it is about the use of debt in bankruptcy, and it's about bankruptcy and orderly resolution. And I start out by acknowledging that in a bankruptcy reorganization of a failed commercial business, the conversation or the conversion of debt into equity or some revised debt instrument is often the protocol. This has long proven useful in transitioning a failed business back into a productive enterprise. However, mandating increased levels of debt as a part of a broad prescribed resolution strategy has potential effects that, paradoxically, may undermine the very financial stability being sought. This may be the case with TLAC, total loss absorbing capacity, as set out by the Financial Stability Board, requires large interconnected banking firms to hold certain levels of long-term debt. Its intention is laudable: to improve the resolvability of banking firms and to assure that, should they fail, they can be resolved without turning to the taxpayer for help. The proposed U.S. version of TLAC would require global systemically important banks, or GSIBs, to maintain TLAC-related debt at the holding company with restrictions on ownership. However, in many instances, to meet the proposal's goal, firms would have to not only maintain current levels of debt, but also would have to add debt to their balance sheets. So in my remarks today, to generate discussion, I will highlight TLAC's effects and suggest that it be used in a more limited and discretionary manner. And I will suggest that its use depend on a bank's business model and Title I resolution plan specifically. Such an approach would, I think, acknowledge that not all business models are the same, and that different resolution strategies might work better for different financial firms and for financial stability overall. Now, TLAC is a necessary component of the single point of entry, or SPOE, resolution strategy that has been proposed but not yet adopted fully in the United States. It therefore is difficult to discuss TLAC without first describing single point of entry very briefly. The FDIC initially proposed the single point of entry to facilitate an orderly resolution of a failed financial institution under what is known as Title II of the Dodd-Frank Act. Now, under single point of entry, only the top-tier bank holding company of the failed firm would be put into receivership. In theory, the parent firm would have enough long-term debt to both absorb any remaining losses after equity is depleted and to recapitalize subsidiaries so that they could remain well capitalized and continue operations under a new holding company. The presumption is that this would all be accomplished without causing overwhelming panic and necessitating additional government intervention. And this would be administered through the FDIC and through a government intervening system. Now, since single point of entry was first discussed, the concept has now migrated and become the principal bankruptcy plan under Title I under the Dodd-Frank Act for all but 2 of the 8 U.S. GSIBs. So it's become now a principal means even under the bankruptcy proposals that might be put forward to the FDIC and the Fed in resolution. The basic theory of this SPOE and a bankruptcy is the same as under Title II FDIC receivership. In this instance, the financial institution would go through bankruptcy without the critical operating subsidiaries themselves becoming insolvent or requiring government support. These operating units could include subsidiary insured banks, broker-dealers, and asset managers. A successful single point of entry resolution under either of these titles, 1 or 2, assumes sufficient internal long-term debt that can convert to equity to effectively recapitalize operating subsidiaries of the holding company following its failure. The Federal Reserve's TLAC proposal further specifies that a clean holding company with its long-term debt is required in order to remove obstacles to the orderly single point of entry resolution of the financial institution. In short, the TLAC proposal is designed to require a firm to have sufficient long-term debt to facilitate a single point of entry resolution, both through conversion of current debt and, if need be, added debt. According to the estimates in the proposal, the GSIBs would have a combined long-term debt requirement of approximately $680 billion. Existing debt issuance would cover much of this amount. but the proposal estimates that there is a shortfall of about $100 billion. Roughly half of this projected debt shortfall would be met through issuing new debt to replace near eligible debt. The remaining half of the shortfall would, according to the proposal, then be filled through the issuance of eligible external long-term debt in the place of existing deposits or other low-cost liabilities. The impact section of the proposal concludes by noting that the aggregate increase in cost of funding, which would come directly out of bank earnings, would be in the range of $680 million to $1.5 billion annually. Other estimates find similar results, and firm-specific estimates are quite revealing. For example, Credit Sight's findings estimate that Wells Fargo has the biggest shortfall of about $46 billion, J.P. Morgan a distant second at $19 billion, followed by Citigroup at $14 billion, Bank of America at $6 billion, and State Street at $2 billion. So there is a need, apparently, to actually increase the debt holdings of some of these firms to make this work under the proposal. Now, the proposal affects firms in other ways as well. For example, Wells Fargo and Bank of New York Mellon do not have large broker-dealers and have not adopted the single point of entry resolution strategy in their living will plans or their Title I plans. In the second round of reviews of the resolution plans, regulators determined that Wells Fargo had the makings of a credible plan, but under the proposed TLAC rule, the company would have to issue additional long-term debt because its current levels are insufficient to meet the TLAC standard. The effective, of course, is to encourage them to adopt a single point of entry resolution strategy. Also noteworthy and somewhat ironic is that the former investment banks in general have TLAC surpluses as they are more reliant on debt funding than deposit funding. TLAC, as it is applied broadly to the industry, would necessarily affect leverage and in some instances place pressure on firms to change their business model. In doing so, it also would encourage the industry and firms to add risk that may be inconsistent with conventional safety and soundness principles or what they would otherwise pursue in business. As firms issue large amounts of additional or more expensive long-term debt and increase their leverage position, such funds must earn commensurately higher returns to meet debt service and avoid default. Such requirements may encourage banks to acquire higher yielding and higher risk assets or expand into non-bank activities such as broker-dealer operations as a means to generate revenues. Also, while authorities might prefer that firms swap out debt, certainly I would, or reduce deposits, or issue additional capital to maintain existing levels of leverage, the companies are likely to attempt to increase leverage to meet added earnings demands and maintain pressure. And the arguments are already starting that since now we've taken care of too big to fail, we don't need as much equity. We should be able to lever up more highly, which I think is a very unstable move. Additionally, in a future recession, if earnings become insufficient to make holding company debt payments, a likely outcome in a recession, then regulators would face the prospect of having to allow the transfer of resources out of the bank to avoid default on the holding company debt. Remember also that unlike dividends, there can be no suspension of debt interest payments. These outcomes would likely weaken the bank and would seem to undermine the principle that the holding company should be a source of strength for the insured bank. To appreciate the potential effects that TLAC might have, it is useful to look at the history of trust-preferred securities, or TRUPS, at banks prior to the last crisis. At that time, regulators permitted firms to issue these instruments at the holding company and to include them as part of capital. Although TRUPS are essentially long-term debt instruments, it was argued that they would be available to help absorb losses in a crisis, relieving the firms from having to hold equity. As the crisis unfolded, the weaknesses of TRUPS revealed themselves as firms often had to move resources from their operating banks in an effort to move cash to the holding company and avoid default. TRUPS placed significant pressures on insured banks to continue making large debt service payments, which most certainly exacerbated losses to the banking system. As it turns out, Congress, in my opinion, wisely eliminated the use of these instruments as part of the industry capital when it passed Dodd-Frank. Finally, TLAC, as is proposed, while increasing leverage, offers no assurances that the amount of debt required would prove sufficient to avoid a failure or panic. There is currently a debate about how much TLAC is enough to both absorb losses after equity is extinguished and also provide enough additional equity to assure the operating subsidiaries are well capitalized. The greater the possible losses, of course, the greater amount of TLAC required, and of course, firms want to hold less TLAC while some regulators judge a need for more. Thus, a blanket rule mandating TLAC should only be embraced with great reluctance. The long-term debt requirement would place added earnings demands on the banking system and could be counterproductive, especially during a period of financial stress. It is, I think, somewhat paradoxical to suggest that the best way to manage the effects of excess leverage and financial vulnerability is to require more leverage, potentially raising financial vulnerabilities. At a minimum, a guiding principle for TLAC when addressing the question of resolution should be that it have at least a neutral effect on the leverage position of the firm and the industry, and that should be done as a mandate, not as an option. So how do we look at this? Well, TLAC is closely tied, as I said, to single point of entry resolution strategy to manage the failure of the GSIB. But there are other strategies that might work perhaps as well and be less reliant on debt. For example, in the U.S., an alternative strategy for certain banking firms, not all, but certain banking firms, could be a bridge bank in which the FDIC is appointed receiver for the insured depository institution, while the holding company and possibly some of the other subsidiaries declare bankruptcy. The FDIC would place some assets and liabilities of the old bank in the receivership, bad bank, and the rest in the new bridge bank or good bank. This strategy would also allow the critical operations of the bank to continue following failure, as the FDIC or its designee operates the bank until it is wound down, sold, or spun off in accordance with the least cost to the taxpayer requirement. This solution could require less debt and may actually encourage more equity, depending on a host of other factors, of course. The point is that a one-size-fits-all solution is not necessarily the best outcome for an industry or for the public. In the TLAC proposal, too little allowance is given for the role of equity held on the balance sheet. This seems short-sighted for me, since greater amounts of equity, I think, and experience shows, increases liquidity and reduces the likelihood of failure. Doesn't eliminate it, but reduces it. Therefore, there might be the opportunity to reduce long-term debt requirements based on the firm's resolution strategy and reliance on equity and debt for funding. What this then suggests ultimately, in my opinion, is that Title I resolution planning process should be the sole means to define the resources and mechanism necessary to assure resolution without public support, not a one rule. Each firm and its regulators should identify debt and equity requirements that have a neutral effect on the firm and that in terms of leverage and the industry's leverage position overall, while also allowing for bankruptcy without public support should a firm fail. So use the living wills process very actively around the right balance of debt and equity for resolution. The process could be used as the planning tool should, for whatever reason, in Title II, should that ultimately be the chosen solution. I would argue that such an approach is more judicious than requiring a sweeping TLAC rule. Under Dodd-Frank, each Title I plan is prepared in detail by management and reviewed and approved by supervisors. Each living will is intended to be based on the specific business model of each firm and the bankruptcy strategy that would work best for that firm. Thus, instead of applying a blanket long-term debt requirement to facilitate one resolution strategy, regulators could use existing Title I planning process to tailor long-term debt levels to a firm's business model, appropriate capital structure, and resolution strategy, better assuring a private sector solution in resolution should it be necessary. And finally, as I have long urged, each firm's Title I plan, particularly its reliance on debt versus equity within the plan, should be made public, as this would enhance the market's role in assuring the right balance within the plans. So let me just summarize. In bankruptcy, the conversion of standard debt is often part of a workable reorganization strategy. I don't argue that. But banking authorities should be cautious before demanding increased levels of debt for individual banking firms or encouraging an increase in the effective leverage of an industry. It is difficult to accept that more leverage solves the destabilizing problem of leverage. If additional debt is used to a specific firm, the amount should be determined on a firm-by-firm basis as part of the living will program, with the balance between debt and equity carefully judged in that process. And during this process, banking companies would have to show that debt could be successfully used in bankruptcy without weakening the balance sheets or ultimately costing the taxpayer money as we have to resolve it. Adding leverage to the banking system in the hope that it will prove to be stabilizing is a gamble. There is considerable evidence that strategies that encourage increasing leverage within the banking industry have in past crises only exacerbated the losses. The goal is resilience, and if necessary, resolution without government taxpayer assistance. That is best achieved not by increasing leverage, but by requiring the right balance of debt and added equity for each firm and the industry as a whole. So I'll conclude with that, and I'm open to be challenged or ask many, many questions, I hope. Back to you, David. Thank you.
Thank you, Tom. Those were very, very interesting and helpful remarks. Let me start out with just a couple of questions.
Sure.
Some specific, a few broad, before we turn to the audience. I think you make a strong case from moving away from a TLAC mandate to a more firm-by-firm discretionary approach. Could you describe in a little more detail what characteristics and features regulators would be looking at in determining on a firm-by-firm basis what the appropriate debt and equity positions of those various firms would be? And is there any potential problem that different banking regulators would look at it differently and you wouldn't have a uniform approach to the application of discretion in this particular case?
Well, I think very good question, and depending on the business model and how much they rely on the broker dealer and how much is in the in the other affiliates besides the bank, you would judge if you're going to first of all start with, do you have enough equity? And there will be differences of opinion. From an FDIC point of view, I would want more equity before it comes back onto the fund. For someone else, they may be thinking of market growth or whatever it is, they might want less. But you have to get through that, and that's part of the capital discussions that go on. So then, how is the firm structured? So some firms have considerable amount of debt, and can they change the conditions of the debt so that if there is a failure, it can be converted take losses, be bailed in, if you'll use that term, as far as private debt, and would that allow enough to have a orderly bankruptcy? And now, that is the $64 question as we look through all of these resolution plans. And since we don't have much experience with that, there's a lot of judgment experience involved in that. And I think it's probably fair to say, if it's structured to where you really do have subordinated debt that takes the hit, you can make many of these cases work. But what that amount isn't defined anywhere. And even if you use a TLAC proposal, many of the discussions over whether it should be 16% of risk-weighted assets or 18%, the same question. And that is a matter of experience and negotiations that will go forward. And I don't have a wand for that. But I'd rather look at the individual firm and say, all right, here's your structure. Clearly, you're going to have a huge runoff, so this has to be restructured into longer-term debt if it's going to be successful, and do it on that kind of a case, as we're doing right now as we review the living wills. So no formulas, that's part of the problem.
So as somebody that doesn't deal with these issues on a day-by-day basis, when I sort of look from the outside at the current status of financial regulatory reform, I can't quite tell. When I looking at it from afar, it looks like we're still debating so many important fundamental issues, and that we still have a long ways to go before we feel like we've crossed the finish line. Is that true, or are we just putting, or are these kinds of issues that we're debating today really just putting the final touches on a process and a regulatory structure that's already pretty well settled?
Dave, I've been in this business for, you mentioned 38 years there and then since, and I've never seen it settled in all those years. It ebbs and flows. For example, I think after the last crisis, there were elements of Dodd-Frank that were useful, but many people think there were elements that were not very useful. So we have the Volcker rule, we have some margin requirements, we have leverage ratio, and every time I pick up a news article or a new discussion, someone wants to revisit that. Your leverage ratio is killing growth. The Volcker rule is onerous and ought to be revisited. So I think that's going to go on. I don't think we're ever going to see that end. I think, when I prioritize, I say, enough equity. I think the Volcker rule does make sense, because when you subsidize, the problem is when you subsidize an industry, and banking is clearly subsidized, you want to get as much inside the bank, your trading activities, because it's lower cost. So you're going to have those pressures always, and that's why I think the principles are have enough equity. The Volcker rule does make sense, and the right level of capital is of paramount importance. And I think when the bankers tell me it's more than doubled, I say that doesn't say a lot. When you have still 5 and 6% leverage ratios using tangible capital. So there's no answer. It's going to go on forever. I think, however, experience and judgment should hopefully stay in front of us. And I tell other supervisors, the one thing that you do, or you're supposed to do, is swim against the current. And that's basically what goes on every day. So,
have we, as we sort of look at the current status of the broader financial system, has the progress on the regulatory front and enhancing overall financial resilience, how even has that been? I mean, have we made as much progress in ensuring the resilience of the shadow banking system, of the other non-bank important financial institutions as we have in banks? Are there still major holes and gaps that you see and are concerned about?
Well, I think we tend to often hear the argument that if we put these capital standards on the banks, it'll go to the shadow banks. But, you know, the most leveraged industry that I think in the financial sector, at least one of the most leveraged part of the industry, is the banking industry. I mean, 95 cents is borrowed for every dollar that's out there. Hedge funds are usually far less leveraged than that. Other non-banks are far less leveraged than that. So I'm not sure that regulating everything necessarily gives you a better outcome. And I don't think we should lose sight of that. I mean, many hedge funds fail, and we don't even think about it. But one major bank fails, and everything comes tumbling down. So my point is, we need to focus on the banking industry. I think putting reasonable capital levels that were there before the safety net was extended as much as it has been, is not a bad thing. And that's capital levels that are double what they are right now. So let's focus on that. And I think the shadow banking system, I don't take it for granted. I don't think it is not going to ever cause a problem, but I think it's not where the vulnerabilities lie. The vulnerabilities lie with 95% leverage.
One final question before I open it up to the audience. If you think about the hat that you used to wear and the hat that you wear today, there's still a lot of discussion about the role of monetary policy in either in creating financial instabilities or ameliorating potential financial instabilities. As you look at the role of the Federal Reserve as it relates to setting monetary policy and considering macroprudential risks, do you think we've got the right framework in the United States? Obviously, some central banks, such as the Bank of England, have a very specific financial stability, financial policy committee that's actually within the bank. The United States has a setup where the Federal Reserve has a seat on the FSOC, as does the FDIC. Are you comfortable with the structure that we currently have for thinking about the interactions of monetary policy and financial stability, or are there recommendations that you would have for improving that?
Well, I think that, admittedly, whether it's here or anywhere else, it's complicated. I do think that the idea of monetary policy should be, people have talked about monetary policy or macroprudential policy being a substitute for monetary policy, and I don't share that view. I think monetary policy needs to be conducted with the long-run best interest of the economy, and macroprudential policy is do you have enough capital? Do you supervise well enough? Individuals that, for example, I'm not a fan of risk-based capital. I think leverage it's clearer, it's more understandable. And when you do things like, well, we'll have a macro policy that says we'll have a counter-cyclical part of that, I'm saying by the time you implement that, you'll be into the third crisis by then. So you have to have what's a reasonable amount of capital, because remember, capital is not a reserve. It's a source of funding that also absorbs loss first and gives you greater stability. Now, so what's the reasonable amount of that? Monetary policy, what's the right policy to give you a macro economy that generally runs stable and makes its adjustments? And if you do that, you'll have a strong financial system and reasonable monetary policy, and they will complement one another. But when you start fine-tuning, not just monetary policy, but now you're fine-tuning supervision policy, I think what you're going to do is create a lot of confusion. Now, the structure around it, I think what we have here is very complicated. I think the FSOC is something that we'll see how that develops. I think, though, the way it's structured at the Fed has worked reasonably well. And I think the role of the FDIC as an insurer has done pretty well. So I don't think the issue of structure as much as it is what the policy is going to be going forward. That's where everything is defined for success or not.
Very good, thank you. Now we'll open up the floor to questions. We'll have a roving mic for the tables up front. If you're sitting at one of the back tables or in the back, please appear at the microphone and you will be called upon. Please identify yourself and your institutional affiliation, if you could. We'll start at the back.
Oh, great. Thank you. My name is Ellen Hughes Cromwick at the Department of Commerce. And I do want to thank you, Vice Chair, for your leadership at the FDIC. You have given all of us out here and the outside looking in just a lot of confidence. And I very much appreciate the presentation that you gave today. Could you comment on one issue I'm very curious about? As you look at different business models, I'm reminded of Mellon Bank in the 80s when they had sizable exposure to energy and LDC debt. And at the time, there was flexibility to parse out the bad debt into what they called Grant Street Bank. And at the time, with a very flourishing high-yield bond market, they issued high-yield debt to gradually write down that part of Grant Street, or in fact all of Grant Street, finally, and then closed the bank. That unleashing of the bad debt and separating it from the balance sheet of Mellon actually was a quite successful business model. Mellon did survive and, in fact, was successful in subsequent years. So question one, is that a business model that could fit into the context of what you've just discussed to us? And then, if you could just comment a little bit about that kind of structure in the context of today where we see energy debt getting marked down quite rapidly. Hard to know where that debt resides and if there are any pockets of that debt that could cause stress in the banking system. Thank you.
Well, it is what you're describing as a model to deal with a problem as the institution encounters the problem. And yes, that model can work going forward, and it could work in the resolution strategy as well. Now, one thing that is required, and that is when you're at that stage, someone's going to absorb loss and take risk. And so when you set up this bad bank, someone has to fund that either through some outsourcing or through, say, other hedge funds or something developing that institution, because you've got to, first of all, you got to write it down, and then you've got to fund it going forward. But that is part of a plan that can work, if they, as it had in that case. But it takes, that's part of what the living will is. If you are that kind of an institution, do you have the wherewithal to set that up? And if that's your plan, if that's your resolution plan or your bankruptcy plan, and is the funding there? And do you have access to the funding? Is it sure? Is it certain? And then we can go that direction. So that's why I think you want to have the process where the business model is acknowledged and then the plan works around that business model. So yes. And your second part of your question was, I should have written it down.
Do we have any pockets of energy debt in our system out there that we should be concerned about? Because that debt's getting priced downward quite significantly from its...
Well, the answer to that is, I'm sure we do. I'm worried about that myself because, people, it's one of those questions I got, a year and a half ago, and they said, is the energy? And I said, well, if it's temporary, it should be just fine. Well, of course, it isn't temporary. And as if you're lending on the assumption of even $40 and you're at 28, you've got some problems. And I happen to be for those of you who remember, I was one of the officers on the lending desk for Penn Square Bank in 1982. God, I hate to say that. And, it goes badly unless you're prepared for it. And I think, though, now, I'm not satisfied with the amount of capital that's been in the industry, but the amount of capital in the industry in 2016 is considerably more. It's not enough, but back then it was less than 3%. Now it's 6% under my measurements. So you have more time to absorb it. If not too many things go bad, you're fine. But The reason we have the living wills is no one knows the future. So it is an area that we ought to be paying attention to. It's in the media every day. I'm not going to deny that. And it is something that where you want to have the resources, the capital resources and the plan to absorb the loss without triggering an event, a crisis.
Over here.
Morris Goldstein, Peterson. Tom, thanks for those illuminating remarks. When you think about TLAC, question that always comes up in my mind is how much are we saving vis-a-vis real equity? Not the costume jewelry, but the real thing. Not debt that gets converted just in time to equity. There's a study out by the BIS, a quantitative impact study of TLAC, and it says that would lead to an increase in bank lending spreads of about 10 basis points. You could do a similar exercise as to what the effect on bank lending spreads would be of a large increase in capital and leverage ratios. And my calculations are that the difference between them would be quite small. So, and you could still, I think, have single point of entry if you had much higher capital. You could pass it down to the subsidiary, take the losses at the holding company, and keep the crucial subsidiaries going. So, I mean, isn't that it in the end? I mean, how much are we saving? Why wouldn't we go for the real equity, and then we wouldn't have the issue that you're worried about, where we're dealing with too much debt with more debt?
It's a great question, and I sympathize with that question a lot. And the idea is that you'll have equity go, and so now you have a failure, and so you want to have the debt after the failure so you can convert it then. And if you have more equity, it just takes longer to fail. And therefore, and then you still don't have a mechanism for dealing with the assets later. Now, my own view is the first thing you want to do is significantly reduce the likelihood of failure, and more equity helps do that. And then you can develop your resolution plan much more effectively around a more equity-driven solution. And that's really part of the argument that goes on. But what I think is going on here is, for some reason, we think that there's going to be this failure and that we have to have this. But the fact of the matter is, we should be arguing strongly for more equity, because the tangible equity that you're talking about is, they report risk weighted at 14, 15%. The real equity is at 5%. And that's the tangible. That's the stuff that absorbs the loss. So if you doubled that, the likelihood of a failure, even under energy pressure or whatever, would be much smaller. You still have debt being issued, and you can require that be structured as a long-term instrument, and therefore in bankruptcy you would convert that. But it would be as a source of fund, just like anything else, not as an instrument designed to make sure that when you fail, you'll convert. I think the incentives are all wrong around that. So I happen to agree with it.
Back.
Bill Klein here at the Institute. I'm having a fundamental problem with your proposition that requiring TLAC will increase leverage. And the problem stems from the price of the alternative sources of funding. If we posit that the assets don't change, we're talking about how does this mandate affect the composition of the funding. The most expensive funding is equity capital, say 7% in real terms, maybe higher. The next is going to be this stuff, which is long-term subordinated debt, or maybe even better, convertible, contingent debt. The next is going to be plain vanilla long-term debt, and the next is going to be short-term debt. Mm-hmm. Now, if you think of the hierarchies of those prices, it seems to me that if you posit, if you tell somebody they got to have more TLAC, they're going to take that. They're not going to reduce their equity because you've already told them they have to have a target equity. And the idea of the TLAC is presumably to shift away from plain vanilla long-term, or even better, shift away from short-term. So it seems to me you have an implicit assumption that somehow banks are going to be running along with lots of excess equity, because the only way you're going to get more leverage with unchanged assets is if when you force the TLAC, they're going to reduce their equity. But I didn't think our problem was that banks were running around with too much equity.
Well, the banks aren't running around with too much equity.
So I'm having the fundamental logical problem of getting a higher leverage when the sole thing that's happening is that you're shifting one kind of debt for another kind of debt and leaving equity unchanged.
Yeah. Now, if your proposition is that you're trading one kind of debt for another kind of debt, then the effect is neutral, right?
Yeah,
but that's not what's happening. You've got to add more debt to make sure you meet your 16 to 18 or whatever the number is.
You can't add more debt without adding more assets unless you reduce equity.
Well,
it's just balance sheet equations.
All right. So you add more debt, you add the asset, but the equity stays the same.
But then that goes back to my proposition that you're implicitly assuming that banks are maintaining a buffer above minimum required equity.
Well,
if that's our big problem, in some sense that
well,
makes me happy.
Okay, you're assuming that the amount of equity they have now is minimally acceptable.
Yes,
okay.
and I'm simply making one simple point. Your entire concern has the implicit assumption that banks have excess equity compared to the minimum requirements, and that the consequence of TLAC will be to reduce their equity and replace it with TLAC.
No, to increase their leverage in terms of borrowed funds supporting those assets rather than equity. I know your issue, but when you had the TRUPS, everyone said this will absorb it, don't worry about it, and of course it created all kinds of distortions when the earnings pressure came down. You couldn't suspend it. So what you had them is tearing earnings out of the bank to get it up so you don't have to default on your TRUPS, because you don't want to do that. And the same thing here. You're going to have them engaged in actions to avoid a default, and also think, so you have this occurring. You have an instance where you have a bank that gets into trouble. You deal with that bank, and suddenly all this TLAC value starts plummeting. People start selling it, and you create uncertainty. Who's holding it? And then they begin to bail out the creditor again. And those are the issues that you face when you hit the crisis. I mean, the crisis, the last crisis, why did we have it?
I think that's a separable issue, but I don't want to monopolize things.
That's all right.
I mean, our
understand what
colleague,
you're saying.
Avinash Prasad has written about fool's gold TLAC because the smart people will all sell it when they start seeing the problem. Then you could have the politicians saying, well, we don't want them to have to default on this stuff, so we'll come back with the public loans and so forth. I think that's a separable issue, but maybe we could do a bilateral on this. It's really an accounting issue, I think.
I wish it were just an accounting issue, but these things incent people to behave certain ways that can be destabilizing. That's the point.
We have a question over here.
Hi, Nancy Jacklin. I wanted to talk about the single point of entry and all as part of a provision that talks about orderly resolution. Well, I guess the problem a lot of us have is if we have a GSIB, and let's assume we have a perfect single point of entry resolution plan that we think is going to work, as soon as the announcement is made that a GSIB is going to be resolved, I wonder whether we can avoid financial panic and whether the world is actually going to sit still. So my next question is, are we looking at the issues of contagion nonetheless when one of these events occurs, and have we done enough to deal with contagion and interconnectedness in the system that can happen as soon as an event like this is announced?
That's a good question. It's kind of back to Dave's earlier point, and that is Does this just go on forever? And the fact of the matter, you raise a very good point, because we don't know, right? Usually we step in because of the concerns about who will lose, and I think that's still a very legitimate point. Do we have enough? I think contagion remains an issue. Now, people say there's too much equity on all this, but before you had the safety net, these largest banks held a lot more equity, tangible capital than they do today, because the market demanded it of them. And the more equity you have, if you have an individual, if you have this, what we like to refer to as the idiosyncratic failure, okay, we might be able to handle that. That's a big if, but we might be able to handle that. But if the industry as a whole has too little equity capital under some definition, then you begin to wonder immediately, are the other banks vulnerable, which is what happened last time. So I start with the fact that you need more equity than you have today. I think the number can be estimated, and I think we should focus on that. And we should focus on that much more heavily than we do on TLAC. Now, if you want to have them structure their debt in a way that it's subordinated and it's longer term, I think that's a good idea. But the contagion issue will turn around whether you have confidence in the solvency of the institution. I'm told over and over again, and believe me, I understand it, but Tom, the issue isn't solvency, it's liquidity. And I say, excuse me, but the only reason I run is if I don't know if you're solvent. You may be solvent, that may not be the issue, but I don't know. Perception's reality. And when you looked at this last crisis, banks that had high capital levels, that is larger regional banks, not just the largest, that were clearly understood to have good capital, did not have runs, did not require any of the bailout money, refused it. So that's why you start with equity as the main issue, and why I think we should focus on that. And TLAC should be part of the living will, get the right balance of equity and debt for that institution and its business model, and then move forward. So I agree with the question.
Back.
Hi, Mr. Vice Chairman. Ryan Tracy with the Wall Street Journal.
Mm-hmm.
I had a two-part question on the living will issue. Mm-hmm. First, could you give us an update on the progress you think institutions generally are making, particularly the largest ones, in getting credible living will plans? And I also wanted to ask, given that you're someone who, in general, I think favors free market rather than government direction of markets, how do you balance that with the fact that under Title I, Congress has given the FDIC the power and the mandate to potentially, order a substantial restructuring of financial firms if they don't have credible plans? How do you and how should your colleagues approach, what could be a pretty substantial intervention with the other part of sort of the way you think about this? Thanks.
Good questions. On the progress, I don't have the ability to describe that to you at this stage. We're in the final stages. We'll look at that and then put that out. So I can't be of help to you on that. On the idea of the free market and whether this is consistent with that, well, first of all, the statute is a statute. So we have these living wills. And so what you want to do, from my perspective only, is you want to make sure it's done as well as possible, not a formula-driven, but well as possible, that they do have the right amount of equity to assure that we don't have contagion to that issue, and also the right amount of debt, should they fail, that could be used to absorb loss. And so, that's part of my duty and my responsibility. Now, if I had my druthers, I'm not sure the industry would like my druthers, because I would say you need to have, we need to go back in history. What was the right amount of equity for the largest, for all banks for that matter, prior to the safety net, and less require that, and then less reduce the amount of regs that apply to that. But the industry is very reluctant to do that, because one of the things I have done is I've proposed for smaller regional community banks a mechanism to reduce the regulatory burden by raising your equity capital and then simplifying for community banks and some of the regionals, I'd get rid of the Basel requirements, the risk-based requirements. Just if you have a 10% tangible equity to assets, no Basel, you don't have to have the sheets for the call report. If you make a qualified loan, or if you make a loan and it's on your books, stays on your books, it's qualified, you don't have to go through all this proof that you did it a certain way. You would simplify that and let the markets work. And if you had enough capital, you can have the failure without the systemic implications almost guaranteed. So those are the sorts of things that I would do outside of it. But we do have Title I, and we do need to make sure that we have confidence they can go into bankruptcy without bringing everyone down. And that's the process we'll go through, I think, fairly carefully and I hope objectively.
Questions at the back.
Barry Wood, RTHK in Hong Kong. Ms. Hoenig, how important to assuring systemic stability in Europe is having a common structure of deposit insurance?
Well, stability is defined more on the strength of the institutions and so forth. I think that what the deposit insurance gives them is a trade-off. What's your moral hazard that you're introducing versus the confidence you give to the broad public in the sense that they don't begin to run and we don't have these chain of events that bring down the institution. So I think if introduced correctly, it can be very pro-stabilizing, but it's not a panacea. And it does introduce the risk of moral hazard, which, when you look at the United States, each stage we tend to extend the safety net a little bit further. And that's one reason I don't want to regulate the shadow banking market, because I don't want to extend the safety net to them. And so that's the trade-off. And I think Europe will be served, but I think that has to be done very carefully.
Ted?
Ted Truman here at the Peterson Institute. Tom, it's good to see you again. I'm wondering whether your role at Penn Square was better or worse than your role in taking telephone calls from me to encourage districts in your banks in your district to continue to participate in loans to Mexico and Brazil. I used to call it moral suasion.
Moral suasion.
Moral suasion.
I think it was whispering in their ear, no.
You probably never did any moral suasion. I just asked you to do it. I was doing my own moral suasion. So I've been away from these issues, and I find them increasingly complicated. But what I heard you saying, I have two questions. What I heard you saying is if the traditional position has been that the holding company should be a source of strength to the subsidiaries, particularly the banking subsidiaries, right? And the whole structure that's been trying to put in place is to do that. And if I hear your basic complaint is the way it's done is they are not a source of strength to. It may be that they will not be as sufficient source of strength to the structure as a whole, which is turning the basic model upside down. So that you're nodding your head yes, but maybe say yes. So the next question is. I'm
listening.
The next question is okay. Yes, you're hearing my question. The next question I had was the really quick question. So we, when we went through the savings and loans and the banking crises in the late 80s and the early 90s, right? The big deal was early action, right? Right. So have we completely lost that aspect of it, right? That you as your capital shrinks, right? And it used to be, I guess it was only when you got to the minimum that you had. But the question is whether there ought to be there should be in the system more capacity to persuade or arm twist or require banks as they were starting to eat into their capital, if you want to put it that way, to take action so that you don't actually get in the position where you have to execute your living will. Or are we now just saying, well, do whatever you want, and if you go too far, then we push the button and your living will takes over.
Yeah. Well, there. To your first question, usually the source of strength for anything is where the earnings are generated. And so we can, the idea of the holding company is that it has the capacity to borrow and download or downstream funds. But usually once you have that there, it's all the other way. So I think the idea of a source of strength is somewhat wishful thinking. All right, because it's where the earning asset as a source is. It's always that way. And if all you have is debt at the holding company, it's there, and it's a potential problem always. On the prompt corrective action, you ask a very hard question because it's not just a formula. If you get equity below a certain percent. Where the real issue of prompt corrective action, in my opinion, comes in is in the supervisory process. And it's very difficult without having triggers. So if you have the right amount of equity and you fall below based on an asset review, then we should have certain actions we take. But if the supervisors aren't demanding that action early on, and believe me, you sit in that room, you sit in the room and you see the energy loans being made. And you see the assumption that it's going to be at this value forever. And you say, well, wait a minute, it ranges this much. I wouldn't say where we are today, but it doesn't matter. It could be commercial real estate. And the person sitting across the table says, look at me. Here's the loan deck. Paid off, on time. Yes, I know I know the loan is 110% of the market value right now, but that's going to change. Paid off. So then the supervisors, get pushed back very quickly. So the whole process of prompt corrective action starts around the supervision process, and whether there are enough triggers early enough, not where you fail them and you take them out of business, but where you get the corrective action started. And I think therein lies a major issue going forward. That's why some years ago I advocated for we do an exam, the collective we do an exam on an institution, large, medium size, and we find flaws, they should have to disclose those. Not based on some, is it significant in our opinion, but controls were weak or whatever. They have to put it out and they can say how they're correcting it, but that there become more public disclosure around it. Not the rating, because that makes the supervisor a rating agency, but the findings. So that you get more prompt corrective action by the market helping you. And that's my wish for prompt corrective action.
Yes, it's back.
Hi, Ron Oral, Daily Deal. We're seeing some of these big SIFIs already start to divest assets in the hopes of being, lose some of the, either get rid of the SIFI designation altogether or reduce its impact. GE's divested most of its GE capital unit, and you have MetLife announcing a fairly major divestiture to reduce, at least eliminate the SIFI designation for that divested unit. And then you have some activists going after, Carl Icahn going after AIG to break into the three, a lot of investors supporting him, and now Ally Financial, a smaller SIFI, under pressure to sell. Do you have some sense of whether this activity suggests to you that the SIFI rules are working, or is it too early to say? And also, secondly, do you think some of these smaller SIFIs, such as Ally Financial, should be permitted to merge with other SIFIs, there's some of them have issues with their ability to distribute capital?
Right. Well, it's a fair question. I don't have an answer to it because there are many factors, of course, that go into the decision to divest. If Icahn thinks that and others have thought, if you break them up, the values go up as individuals, so the value of the whole is much bigger that way. And so that's the market at work, which I prefer. One of the factors that interferes with that process, I think, is the fact that the banking industry, the regulated banking industry, has this safety net, which affects the cost of doing business and therefore the desire to break up or not break up. So what you're doing is saying, are you raising the cost in the supervisory point of view through the SIFI rules to make that no longer as enough of an advantage to want to stay together? And of course, you don't know the answer to that. That who's ever doing that analysis will give you whatever reason sells best. But I think that certainly some of the divestitures are recognizing that values are broken up or greater. That's the market part of it.
And that the regulations would be reduced, or concerns about the capital and liquidity rules?
Well, I'm assuming that they are, number one, that their operations will run more effectively. I think that whether you have regulations or not, that has to be part of it. And then in that is the fact that, will this reduce some of my regulatory burden? Okay. And that's how they weigh those. Each one weighs it differently. But it's going to be a factor in the process. So
is it working? Does it show that this show that it's working, or it's too early to tell?
Well, if the goal, what's the goal? If the goal is financial stability, I'm indifferent. If the goal is to break them up and it's working, then yeah, I guess in those few instances, but in the major cases, it's not working. The subsidy is really quite rich.
Okay. And then the smaller SIFIs, they be allowed to combine some of these regional banks, or is that problem?
You mean, should regional banks be able to combine?
Well, yeah, for example, Ally Financial is under pressure to sell itself right now by some activist hedge funds.
Well, I think depending on what, bank holding company rules and all this, I think that's the market at work. I don't see anything wrong with that, other than, there are many hedge funds that do not want to be bank holding companies. I can tell you that much, and that would be an impediment to that.
At the back.
Hi, I'm Lalita Clazel, American banker. So about the living wills determination process, would you say that the issue of liquidity in the event of a failure, is that the main sticking point?
Liquidity?
Yeah.
For the living wills? Well, no, that's one of the issues. That is, if you go into a bankruptcy, will you have the ability to fund, in other words, will you have the liquidity necessary to keep operations going on a day-to-day basis and avoid flight of funds and make sure you have the funding? That's a big issue with them, and that's one of the issues they have to address in their living wills process itself. So it's not at this point. I don't have an answer for you because the living wills aren't completed yet.
Final question. Seeing any takers? Tom, thank you so much for joining us this afternoon and being so patient with all of our questions and queries. I think this was a very enlightening discussion. Thank you. Appreciate your participation.
Thank you all very much. Thank you.